Good evening, everybody. Thanks for coming down. My name is Eric. I'm working at this Aggregate Asset Management. I'm the fund manager there. So I tell you a bit about what I've learned over my last 20 years investing experience. So I think that would be better than going into the technical details. So myself, like everyone else in Singapore as a student, we work very hard. But of course, I'm a B student, not an A student. So our children work very hard. And after they go to university, this is what they do. They get a good job, take the train to work. Then after that, their life gets a bit better. And they start to upgrade. So now they can drive to work. So after a while, 15 years, you realize that there's something wrong. I think that's the basis for the Occupy Wall Street. They're wondering what screwed them. They don't really know what screwed them. So this is the office environment. This is a reason for them being screwed. First, I must tell I'm not a communist. This is just taken from a passage. Labor is a commodity like any other, and price is determined by same laws that apply to other commodities. So price of labor is also equal to the cost of production of labor. So which means that the worker would therefore get no more for his labor than is necessary for this purpose. The price of labor or the wage will, in other words, be the lowest, the minimum required for the maintenance of life. So what it means is that your boss will earn all the money, but he will give you very little. Just enough for you to survive. So what are you going to do? So you have to join the capitalists. Feels like that most days at work. Then after that, I think that it's time to put capital to work, right? So how do you do that? Invest in the stock market is one way, where you use money to make money. Then during the early days, I attended this, that time they had all these commodity bucket shops. So I attended one, in Tanjong Pagar, then learn how to read charts. That time you don't have to pay $5,000, it was free. You just go and then, you just learn it. No money is required. So you're supposed to look at this and say, where is it going to move next? I looked at it for a long time, but I couldn't see any pattern. So any of you who are doing technical analysis, I just tell you that please don't waste your time. Okay, this is Ben Graham. He's Warren Buffett's mentor. Many people know Warren Buffett, but they don't really know him. So what he say probably should have some value, right? Okay, this is what he said about technical analysis. One should buy because the stock or the market has gone up, and should sell because it has declined. So this one is the exact opposite of sound business sense. So in his last 50 years, he has not known a single person who has made money by using technical analysis. So Graham, being the mentor of Buffett, tells you that over the last 50 years, he doesn't know anybody who has made money using technical analysis. So will you want to go against his reasoning? But I know there's one way to make money from technical analysis. That is to teach a technical analysis course. That's the only way. So why I go through this? Because if you do this, it's going to consume a few years of your life. And you're going to waste precious time. So just forget about this, the shortcut. So what's next? You invest based on listening to news. Like just now, before I came, my wife asked me to read the news on the Greek exit, you know. Said that someone is going to ask me whether the Greek is going to exit or not, and so on. So I just kept quiet. I didn't say anything. So you watch the news. First, you have the euro, you have the Greek, you have SARS, you have MERS, you have oil crisis, you have all sorts of things. You have inflation, deflation, all sorts of things. So after a while, you realize that watching the news to get your investment ideas is actually like this: watching the news. After you watch it for a while, you realize one thing. It's like watching Korean drama. Somebody died, somebody is going to take revenge, somebody is going to force marriage or whatever. Boyfriend ran away, girlfriend ran away, and so on. So all this watching news and the experts is really no use. They are there to sell news and to make money, not to help you to invest. So don't do that. So what do you need? So I summarize it. You need two things. You need to buy this book. But this book is quite hard to read. But I think it's okay, like you just slowly read, and then you'll be able to know the fundamentals of investing. Then you need basic accounting knowledge. With these two, I've already saved you $5,000 because you just buy the book. It's only like $30. Then this one you can borrow from the library or buy second. That's another $30, $60 to get the job done. But then if you want to something more understandable, don't want to go through Benjamin Graham's kind of writing, you can actually read this book. So when I first met Hui Ling, I just asked her one question. Why are you revealing the secrets of investment to everybody? So now I'm doing it the second time, revealing it as well. So buy this book. After you read this book, then you buy this book. Even a PSLE student, can appreciate reading this book. So after you have these two, and you look at it very carefully, you won't be wasting time anymore. There's nothing difficult in value investing. PSLE mathematics, you can do investing already. But I think most of us here cannot do PSLE mathematics. Even me, I can't do it now. Okay, then you ask, what is the value approach? Which value approach should I use? There are so many people teaching value investing. So which value approach should I use? You can use low PE. There is also a low price to book. There's also a high dividend yield. There's Benjamin Graham's net current assets. Now, of course, we have this aggregate. We have the 6-year historical intelligent transformer model. So the truth is that all value approaches work. If you apply the low PE, high dividend yield, low price to book, low price to cash flow, it should all work out quite well. Okay, there's something that I need to warn you a bit. If you go to the bookstore, you want to do anything about investing, you will look at Warren Buffett's book. Warren Buffett's book is everywhere. But this is what his mentor say, Benjamin Graham. So pay some attention to it. So investing, you can classify into speculative and investment. So investment means that you look at intrinsic value factors. That is, this part is considered investing. This part is considered speculative. So investment means you look at earnings, dividends, assets, capital structure, terms of issue. So these are you can find in the balance sheet and income statement. Just looking at these two will allow you to make an investment decision. But if you go up higher, you look at management and reputation. Okay, management is very good, very charming, very charismatic, got a lot of growth, work very hard, blah, blah, blah. That will be under management and reputation. Then this one is competitive conditions and prospects. possible probable changes in volume. So this part you notice, it falls between speculation and investment, is here. And speculative, of course, looking at technical chart, head and shoulders, blah, blah, that is completely speculative. So you look at this part is very difficult to handle for most people. And this part is usually, that's when you lose money, because you pay too much money for stock because the management is reputable. So this is a mistake that most people make. So just concentrate on this. This one is the evolution of an investor. At first I started as a chimpanzee. That was 20 years ago. Technical analysis, day trading, news reading. Then after that, you evolve to value investing. Hopefully you can become Optimus Prime. But in the search for value investing, there is one mistake that I find that, including myself, they make, is because of this reason. They take a detour because of this man. So he can, if you do it right, it's right, but he costs most people a lot of heartache and pain. Because if you go to the bookshop, you see all his books. So you buy any book, Warren Buffett. This guy is a con man, Trump. Buffett, all Buffett. The only one is this one. Okay, so this is rare. Why he mislead you? Okay, first, not many people can be like him. I don't know how many billion he has, 60, 70 billion? Not many people can be like him because he worked really, really hard to be Warren Buffett. So if you think you want to be Warren Buffett, first is quite impossible because temperament is out already. If you have $70 billion, will you live in a house like that? Whereas a Singapore tycoon with $1 billion live like that. So not only that, you look at Warren Buffett's car carefully, it's a Toyota Camry. So how many of you think you can be Warren Buffett? I think the price is too heavy to pay to be Warren Buffett. Then another thing I want to show you, if you follow Warren Buffett's approach. This one is a page from the secret manual, the Kung Fu manual. Okay, it looks nothing, just a few lines. Okay, what it shows here is from year 0 to year 5. At year 0, you split the companies in the US S&P 500, you split into 5 buckets, 1, 2, 3, 4, 5. So you put 20 here, 20% of the companies here, 20% here, 20%, 20%, 20%. You allocate it by the ROE, return on equity. So here is almost 0, 1%. That means very poor rates of return on capital. Means lousy business, or means business having problems over here. Then here is slightly better, but still bad. Right at the top is businesses earning 25% rates of return on equity. So these are the good companies. Maybe it's like Google or Apple or whatever. They will probably be here. So what happens after 5 years? You can see the rates of return from the top companies starting to drop. Maybe last time Samsung was here. Then Samsung comes to here. So inside this bucket, on the average, they slowly decline. And those that are at the bottom, they slowly improve. So this is good news if you are the worst student in the class, because it shows that you can only improve. So do you want to invest in the worst student in the class, or you want to invest in the top student in the class? So invest in the top student in the class, it may mean that when he drops to number 2, then your investment is finished. But you invest in the last student in the class, but you must make sure you don't die or do drugs or commit suicide or whatever. Then you get a better result. So Warren Buffett emphasized good quality companies at the right price. So you must make sure that at the right price, make sure you don't pay too much. So that is dangerous. if you don't know how to implement that. Okay, this is a Warren Buffett style. Straight away you become Optimus Prime. But if you don't know how to handle it, this is what is going to happen. Okay, compound interest. This one, everybody thinks that they know what is compound interest, but they underestimate compound interest. Okay, just imagine you started out working, 25 years old, 30 years old, you drink a cup of coffee, Starbucks. Every day you drink one cup, just to reward yourself. So you deserve a break every afternoon with your friends. So assume you are 20 years old, you forgo the Starbucks coffee, but you invest it using value investing and grow it at 15% a year. Of course, this one you'll be very lonely because all your colleagues go and drink Starbucks, but you stay in the office. That is a social, psychopath or whatever, got some problem, right? How much will you have at age 50 from investing? But this one means that probably you don't get promotions because you don't go and drink coffee with your boss. So $6 times 365, $2,000 per year. So after 10 years, 40,000. After you will ask me, hey, how can you assume 15% and there's no such thing, right? How can people grow money at 15%? That is nonsense. But later I tell you how. So after when you are 50, you got $15 million just because you didn't drink Starbucks. But this one, the main assumption is that you are growing money at 15%. Later, Hui Ling will show you how to grow money at 15%. For me, I'm just in charge of telling the jokes. She will tell you how to do it. So if anything goes wrong, please look for her. Now you know why this girl is drinking plain water. What is your compounded return from managing your own investments per year? How many of you can do more than 20% a year long term? I think most people will say probably they can do 10%, they are quite happy, am I right? So you don't know. Actually, some people also don't know. You manage your money, you buy stock A, it went up, you sell. You buy stock B, you lose money, then you keep quiet, So in the end, what is your return? So most people don't know what is their return. That is bad. Okay? You must know what is your return. Everybody who is an investor must know what is your return. If you don't know what is your return, then you shouldn't be investing. Because I'm in fund management and sometimes I have conversations with people. So sometimes they will say, they attend this course, that course to learn how to invest. But they always never ask the speaker, if you are so smart, right, what is your return? Nobody asks them that question. Maybe his return is minus 10%, then now he is standing here talking to you, telling you how to invest. Right? So you must know your return. If you know your return, then you won't fool yourself. Use this method to track your performance. If you don't know, you just Google it. So after I've been marking around for many years, then I managed to get into the fund management industry when I was 33 years old, 33, 34. Then I managed to get in. Before that, I wasn't in fund management. I was working as a computer programmer. So when I get into fund management, then I started investing. Then I started to keep track of my track record. At first, I didn't keep track of the track record. Just buy, sell, lose money, win money, doesn't matter, don't know at all. So you must always keep track. So what I did was, I started keeping track in 2005. Not very long ago, right? 10 years ago, right? So this one I was working in a fund management company. So when you track your returns, you must always match it against the indices. So I started at $1. So after 2007, it went to $2.50. So that's quite a good job. But then the crisis came from $2.50, it dropped to $1.50. So which means that if you have $250,000, it will drop to $150,000. So you lost $100,000. So this part is very, very scary, the 2008 crisis. But after that, it recovered. This is my own tracking of my own personal performance. That's why I tell you, you must track your performance. After I tell you why you need to track your performance. So after I track this, the markets also went down. Then these indices are the Nikkei, KL, Kuala Lumpur, and Hang Seng and STI, all these. Then after a while, I think I win them, no need to continue tracking, forget it. So I just continue along the way. So from $1 to $4. Then the indices remain more or less flat. So when I track this, then I learned that, hey, I actually got a good process. And I should use this process. So that's what you should do. You should track a performance. And if you got a good process, then you should use it for yourself. Then after that, I started me and my friends, we started Aggregate Asset Management. So this is a continuation of our process. The blue line is ours. So we started at $100 in 2012. And now we are at 148, whereas the index is at 127. This one is not marketing, I'm not trying to sell anything. What I'm trying to tell you is that you need to track your performance. And if you are doing a bad job, then you should stop managing money. So when you track your performance, this is what's going to happen if you are doing well. You feel a lot more confident and you put in a lot more money. So tracking performance is the next thing that you need to do. There's still one problem. After you've done all this, there's still one problem. That's why I say you must track your performance. If you track your performance, then this problem will disappear. This is the problem. This one is rojak. So I explained to you why this rojak, even though it's delicious, but it is stopping you from retiring. Okay. Just say if you are very rich, doesn't matter lah. Even you spend interest also cannot finish spending, right? But if you are not very rich, you are a poor millionaire. You got $1 million. After you do an investment, right? This is your portfolio. You have fixed deposits, 200K, unit trust, blue chips, bonds, gold, bird's nest, CVIT, land banking, foreign currency. You have all this crap, right? All this rojak. So these are your returns. 1%, 4%, 6%. Blue chip, you do quite well, 6%. Bonds, 4%. This one, you never lose money, you're happy already, but I just put 1%. So in the end, you add up, your average is only 3%. So if you do this, 3%, the inflation rate is 3%. It's actually 2.8%. So what's going to happen? Nothing is going to happen. Your money will just stagnate there because you are earning 3% from this rojak thing. Inflation is 2.8%. You will go nowhere. This one, after adjusting for inflation, is 1 million. It still remains the same. So that's why I say you are a poor millionaire. So what if you are a good stock picker? Just say you are really good already. You can do 15%. Then what? So your bonds, FD, blah, blah, 3%. Equities, you can do 15%, right? You become very good already. Unit trust, 3%. Insurance, 3%. You average out, you get 5.4%. 5.4% is still no use because with 200,000, it will take you 70 years to reach your goal of 1 million. Just say you want to retire at 1 million. 200,000 at 5.4%, 70 years, after you adjust for inflation. So that's why I say it is very, very difficult. So after a few years of tracking performance, that's why you need to do it. Then what do? You do a full allocation to equities. That means you put your money to work where you can make 15%. And you can only make 15% if you have done all your homework, reading all those books and investing and tracking your performance. Then only you would dare to do something like that. just now we show the man in the cage. So what is the price of freedom, the magic figure? This one is called the withdrawal rate. So if you, just say if you want to retire or aim to retire, you need $50,000 a year. So you take 1 million, 5%, that will give you $50,000 a year, which is about $4,000 a month. So this is a magic figure. With $4,000 a month, you eat at a coffee shop, take MRT bus, still okay lah. You can't drive Ferrari, you can't simply do fine dining, you can't do all that. But it is good enough to purchase the freedom for young people. So if you have 200,000 now, your end goal is 1 million, you adjust it for inflation is 1.5 million. Number of years to get there is 15 years. The initial investment is 200K. The compounded rate of return is 15%. So which means that if you have 200K now, if you invest at a rate of 15%, you are going to get 1.6 million, which is the equivalent of 1 million in today's thing. So there's hope. So if you have 200K, you just need to wait 15 years to get $1 million. But of course, if you want to spend 100,000 a year, then you need $2 million. You need to spend $200,000 a year expense, you need 4 million. It's just 5% of that figure. So again, I say, how do you get this right? Later, Hui Ling will tell you. Okay, I just give you I stole this from a chart. Basically, it says this. If you consistently buy low price to book stocks from 1994 to 2014, your compounded return is 16.4% for the lowest price to book portfolio. For the MSCI Singapore, total return is 4.6. So this is the secret. You must buy value stocks and you must invest consistently. So what if you have nothing? I think those who just started would. So to get to your $50,000 a year or 1.6 million in today's number is 1 million, right? You need 14 years. So you invest $3,000 per month at a 15% rate of return. So there's hope. So you can save $3,000 a month, you invest, buy all the books, read all the books, get your 15% return, blah, blah, blah. After 14.4 years, you are free. So even you don't have 3,000, you put in $1,500 per month, you can still get there after 19 years. So for the young people, it's not too bad lah. You are just say in your 20s, you do that for another 20 years, you get this. So the key points I want to make is, you stick to value investing. It has shown to work. You must track your performance. Don't have a rojak portfolio. Then any value strategy will work. This one you can find out by reading books. I won't go through all this here. And you have to start early and invest consistently. Thank you.